Hello, can you hear me now? Oh, I don't know what's going on there. My mic was on. Right, let's. I've been waffling on for the last 5 minutes. Didn't realise no one could hear me. Right, well, let's start again. Good morning. Welcome to the Flow Show. Another busy week ahead. We'll get cracking straight into it. Just me on my lonesome today. No K-Man, he's at a doctor's appointment getting his leg sorted out. So just got me, myself and I today, all three of us. Right, let's kick things off then, get straight into it. China's economic fundamentals are likely to improve and thus support the yuan, according to a PBOC backed paper. This is one of those things that they put out now and again, giving a hint of what they want to happen. They say that the yuan exchange rate versus the dollar will show positive changes after bottoming out. The Nikkei reports, though, that the weakened yuan has cost China's top developers close to $3 billion. They would want to see that going the other way now if those losses are going to continue. Now, China's not going to get much help from some of the banks and financial firms because they are now prompting the yuan as the new carry trade. Instead of borrowing in the likes of Japanese yen, while the BOJ is at low rates and parking it in higher yielding countries and currencies, they say the yuan is now an attractive option for the carry traders. I'm not sure it has the same abilities as the yen, parking it in the yuan, because we know that the PBOC have been more forceful in protecting levels of the currency, whereas the Ministry of Finance in Japan may not be happy to let the yen weaken, but as long as it's not doing it in a volatile way and too much of a speculative way, they are happy to let it go. So I think the yen is going to stay top dog for now. But no surprises to see some of the banks trying to flog their other wares and getting people to move around. Over in the UK, there was a trade body report from Make UK, and they expect manufacturing output to fall 0.5% in 2023, down from its last forecast in June for a 0.3% drop. They expect just 0.5% growth in manufacturing in 2024. In the commentary, they said manufacturers are seeing a very sharp slowdown in activity as the potent cocktail of rising rates and the cost of living and slowing overseas markets bites hard. This is important for a couple of reasons. Well, firstly, the manufacturing sector in the UK isn't huge, some 12 to 15% of GDP. However, the reasonings behind the slowdown, if they translate across to the wider services sector, going to mean that the UK is going to face some heavy slowdowns. This is one of the things we're going to have to be looking for as we move towards the end of this year and into next year, playing the rate cut trade and the growth trade amongst currencies, and who's going to suffer the most as rate hikes bite. The UK would be pretty top of my list if rates continue to keep going high and stay high. We'll see the effect quite negative, but you know, there's times when the market gets very bearish on the UK, and we have often confounded those expectations by doing better than the market expects. But this time I think we could see a bit of pain coming, but we'll keep an eye on news like that in manufacturing and services. Over in the Eurozone, and Eurogroup Chairman Donahoe says the Eurozone economy has lost some momentum as a result of past shocks and some policy decisions. And it seems like the bill for all the COVID interventions are coming due, because EU Commissioner Gentiloni says we need to support ECB in taming inflation, and fiscal policy needs to be restrictive. It is essential we reach an agreement by year end of the reform of EU fiscal rules. Now, all those rules got, let's just say, loosened over COVID and everything else that's come in, the cost of living crisis. countries using fiscal measures to offer subsidies for rising fuel prices, energy prices, etc. That's not something that the EU as a whole want to allow to happen or continue happening. So the bills, as I say, have got to be paid for at some point, which means that the EU is going to be really pushing for fiscal tightening, particularly coming into 2024. So again, that's another thing to watch in terms of what happens with monetary policy and governments. All the borrowing that they did, they need to rein it in, get back to reasonable debt levels and EU rules, and get their houses in order. That will be a huge bum fight we're going to go through next year, because there's one thing that some EU countries like to do is not adhere to the rules and make loads of excuses about why they're not. But that's for next year. But as you can see, the EU Commissioner and Eurogroup Chairman setting their stalls out early. ECB's Lagarde was out on Friday, just reiterating, pretty much repeating the statement that we heard last week, saying we will return to 2% inflation target. We will set rates at a restrictive level for as long as needed. ECB's Kazakhs said that the Thursday rate hike was not a dovish hike and does not preclude future decisions, is comfortable with the current level of rates, and that the macroeconomic projections do not support an April rate cut. The ECB must decide on how to remove excess liquidity before it can cut rates. So the talk of removing that liquidity is popping up in a lot of ECB speakers. ECB's Simkus hopes that the ECB has raised interest rates for the last time. ECB's F.A.C.E says core inflation is still relatively high, can't exclude further hikes, but it depends on the data. And as just mentioned, the rate level opens more space to discuss QT. He's also kicking the can until December, saying we'll have much more data for the December meeting. ECB's Casimir hopes that the SEP hike was the last, but can't rule out further hikes. Once it's clear no more hikes are needed, the debate should start on speeding up QT. Yeah, another one talking about QT. We may need peak rates for winter, spring and summer going into next year, and it's premature to place bets on the first rate cuts. Now, QT might have been something that they could have pulled out the bag at the meeting last week, just to keep things a bit more hawkish, saying, you know, we may be stopping with hikes, but we're going to increase QT to draw more liquidity out to get the balance sheet down. They held off on that, but as you can hear or see, some members, ECB members, are leaning towards pushing that as the next policy move. They can't be cutting rates while they're still reinvesting or still doing mooching the QE around the system, sloshing around the system. They need to draw that out, or rate cuts will have a double easing effect, and they don't want to do that. They want to ease too much rather than ease just enough. So they need to drag out all that liquidity, which is what these guys are banging on about now. Over in the US, just catching up on last week's data, we had the Empire manufacturing numbers coming out, and they were pretty good. I'm on the right page. Let me see, where are we? Yeah, should be on the right page. Where are those numbers? There we go. Empire manufacturing was expected to come in at -10, came in at +1.9. So pretty decent turnaround. This one has been a bit volatile of late. So, you know, it is the first manufacturing number of the new month and often a bit of a bellwether, but it has been a bit flip-floppy of late. Employment got worse. It was down 2.7 versus -1.4 previously. New orders improved, up 5.1 versus -19.9. Prices paid was up a bit, 25.8 versus 25.2 prior, and expectations improved as well, 26.3 versus 19.9. So current things at the moment looking fairly good, but that employment number a little bit softer. We also got industrial production out, and a little bit on the flat side. Industrial production up 0.4, but manufacturing 0.1. As been mentioning, a lot of 0.0 points coming into the manufacturing type data. Nothing really good. Capacity utilization rate was up. That's the amount of space in factories. Higher number is more positive. So that was looking good. Then later on, we got a bit of a soggy Michigan survey. Headline number coming in much lower than expected, 67.7, missing the 69.1 previously. Current conditions also a good chunk lower. People find things a bit tougher on the streets, it seems, 69.8 there. A drop in the inflation expectations as well, 1 year dropping 3.1%, quite a hefty dip, as was the 5 to 10 year inflation, down to 2.7 as well. That'll be good news for the Fed. That means that inflation expectations are softening, and that will affect how consumers approach their buying habits. So that's good for that side of the inflation picture. Overall, it seemed like soft data. The consumer number isn't that good, particularly after we got the retail sales as well, which showed some signs of positivity, although the core sales was largely flat. But yeah, we're just seeing a little bit more on the consumer side that perhaps we should have some worries in the back of our minds, and we'll see whether that gets reflected at the FOMC this week. Moving on, Canada, they had some manufacturing sales, which were not something I often look at, just a cursory glance, but they were pretty positive, 1.6% on the month, reversing a 2% loss last month, much better than the 0.7 expected. And just going back, some import-export price data from the US as well on the month showed higher prices year on year, not falling as much on the export side, falling a little bit more than expected on the import side, but still less than they were last month. So maybe just a little bit of what we've seen in the last couple of CPI reports and PPI reports, showing a bit more stickiness in the inflation picture. Just a couple of geopolitical headlines. Looking at this US car makers strike going on, and Biden's coming down on the side of the strikers, it seems, by saying that car makers' record profits are not shared fairly with workers. So leaning towards the strikers' side of the debate on that one there. And it's not really a big headline, but it could lead to something that Ukraine is going to be suing EU countries over their grain bans. The close neighbours of the Ukraine, who are also a lot of grain producers as well. Obviously, Ukraine's in a bit of a pickle where the grain routes out to other countries have been shut off by Russia. They need to get their grain out some other ways. Exporting to other EU countries is all well and good, but there are quotas and whatnot in place. And so what some of these countries like Poland have said is that we will not take your grain, which puts a bit of financial pressure on the Ukraine, because obviously they're not selling it, they're not making money to pay for the war. It's not a big headline in itself, but it does create potential problems with other EU countries or worse relations, which is not what the Ukraine wants when they want those countries' support for the war. So we have to see whether it leads to let's call it wider tensions between the supporters. It could mean that we see some countries dialing back on their support for the war if this thing kicks off. But just something to bear in at the back of your mind. Nothing for now, but it could just affect the picture of support for the Ukraine war if that develops into further hostilities. Right, that's it from the news front. We got a couple of questions coming in. Let's have a look. Ali, as always, popping up with his questions. Short dollar yen at 65s. Let's get into dollar yen. Stop loss at 148.05 and a TP 147.35. I'm the opposite side to you. I tried to grab this break last week. Ended up getting stopped out for 20 pips. I was long at 85, got stopped out at 65. I got back in at 66 on Friday, and it's not looking too hot. I did knock some out at 86 just to get half my money back on the stock that I got blown out of. My balance on the stock of this part is at 45, so I might give back 20 on the other half. It's definitely, we found this level solid again. I thought we might be getting a bit of a blow through, hence my long last week, but it's not looking likely, and this level is still up at the 85s, 87s, is still proving pretty solid. So that is our marker for that. We're not dipping too far though, although we are just nicking lower lows now, just on the short-term intraday basis. So a pretty solid top looking up here at the moment. Obviously, with the Fed and the BOJ coming up this week, the market may not stray too far from these levels. I certainly think at the most we may be just mooching around between there and the 147. So I wouldn't be surprised if we saw more downside. Your short's looking okay at the moment, mate. I think 148.08 is a big level. If we get up there, it means something's definitely changed in this area. So while we're below that 87, you've probably got a half decent trade on. But I'm going to hang on to mine for a little bit, but I might get it out for the Fed. Only a bit of a scalp, so I'm not going to worry about it too much. The other question: what will the market first reaction if BOJ intervene? Right. Well, you know the story, Ali. They only intervene if there's A, speculation, and B, volatility. They have, well, one person has mentioned speculation, that's Canada. The others that I recall haven't yet, and we haven't got the volatility. So for now, forget intervention. It's out the window unless we get some real volatility over the Fed, which I doubt, and that will be Fed-driven, not yen-driven. So again, it's not the same type of volatility. But the intervention risk is really only if we break above 148 and we see us taking off, really taking off. If we go 148, 149 pretty quickly, that might get the jaw boning out. But this going sideways in a 80 pip range is not intervention territory from those guys. Right, just looking at some of the other pairs. Well, no, let's have a look at what's coming up this week first before we look at the prices, because it is quite a big week. We start getting some housing data through this week from the US and a couple of bits from Canada as well. So all the housing market index starts and permits tomorrow, further housing, existing home sales, so on and so on this week. Obviously, we've got the big central banks as well coming up. We've got, I think there's something like, I don't know, 12, 15 central banks. It's a silly amount. A lot of, obviously, smaller countries. But the main ones, we've got the Fed, BOE, BOJ, SNB, Riksbank, Norges Bank, all this week. So the Fed is obviously on Wednesday, BOE on Thursday, BOJ on Friday. So all these we need to keep an eye out for. And lots is going to happen for these, which we'll get stuck into each one probably over the days ahead. No need to get stuck into it too much this week. But on the data front, we have a lot of data coming up as well. Final inflation numbers tomorrow from the Eurozone. Shouldn't be too much of a mover, but if there's a big variation to the flash numbers, that might change around some of the ECB thoughts. Canada CPI, that could be a biggie tomorrow because we have seen Canadian CPI jumping. If that starts to form a bit of a trend, that's going to bring a BOC that has already turned a bit more hawkish in their last meeting. That'll get them further hawkish and probably get the market starting to price up another hike from those guys. So that could be big numbers tomorrow. Wednesday is a big day as well for the UK. Ahead of that Thursday BOE meeting, we get CPI numbers from there. Now, CPI, let's get up my calendar. CPI in the UK is expected to rise to 7.1% from 6.8% on the headline number. The core is expected to drop a pip to 6.8 from 6.9. So further inflation pressures there in the UK expected. Wouldn't be a surprise really to see a bit of a high print. You know, we've had all that wage data coming through as well. However, we might be seeing a bit more of the energy pricing coming down, feeding into inflation numbers. So inflation coming lower. So I think it's a bit of a coin toss which way this one goes, but the market's expecting a 3 pip jump in the headline, a 1 pip loss in the core. That's going to be important, not so much for this meeting because I think a hike is done and dusted, but it'll be important for the message going forward as to what they do after this meeting. So if it's a super hot inflation print, then the Bank of England are probably going to be forced to talk a little bit more hawkish. If inflation is lower in this number here, then they'll still keep the warnings about fighting inflation in their message, but we know they're reluctant hikers, so it might mean a more neutral to dovish sounding announcement there. So that's important data on Wednesday. Obviously then we get the FOMC, that's going to be in the evening there, and we'll get to hear what Powell has to say about things. Market's still not pricing a hike. It's like 99.2% probability of keeping rates unchanged. So really, if they do hike, it's going to be a bit of a shock to the market. I still think there's a higher risk of them hiking than the market says, but I don't think that risk is as high as I placed on the ECB last week when they hiked. So I'll probably have it as about a 30% chance that they may hike on Wednesday. Over on Thursday, Philly Fed, the next numbers from US manufacturing before we get into the PMIs on Friday. As you can see there, we start getting all the flash PMIs, Bank of Japan, UK retails, and so on and so forth, Canadian retails as well. So plenty of data to keep us in the mix after we get all the central banks. So there's going to be a lot of to and fro here on the price action. Right, let's take a quick look at some of the prices. We've already spoken about dollar yen. I'm not expecting a lot from many markets right now as we wait for the Fed. You know, euro dollar still below 107. That's the important number there. It's just mooching around in this area here. We haven't had another test of the lows down towards the 30s. If we get another test down there, as long as there's not big news, I'd expect that sort of level to hold, and maybe we just ping pong in the middle. This week is about getting prepared for all the events we've got coming. It's a bit difficult to pick a side into this with all things like the Fed and the data going on. We know we're heavily data dependent. These last data points are going to just feed expectations for the Fed and the others at the last minute. So there could be a few jumpy moves around, but I'm not expecting any big breaks anywhere. If we do move down lower, for this one, some of the bigger levels underneath, we get down to that 38.2 fib, and this traffic area down in the 106s down to 105s. This is going to be another big level, huge level. If we get anywhere close to that, a big decision to be made there. A bit like we had here at 107, but this one is even bigger. If I pop it on a, let's put it on a weekly. Might not be too clear, but where are we? There's the 105. It goes all the way back 2017, 2015. All the way back there. It is a huge humdinger of a level. So that one is going to be watched closely if we get down there at any point in time. If the Fed drive it there, we'll have to make a decision what we want to do there. But it's definitely a level I'm going to be looking at to trade. Coming into some of the other pairs, Euro Sterling could be a decent one this week, obviously with the Bank of England. We're knocking up around the 86s. Mooching around it, just staying above it this morning. Again, I don't know how far this one's going to go, but this could be a decent one to get a Bank of England reaction on. If we get a neat jerk lower, i.e. pound strength, because maybe they've hiked and maybe there's a strong message. I'm in the same boat, or I'm putting these in the same boat as all the others. If they hike now, they're probably done, unless the data, inflation data, really starts picking up again. If they're done, then we're going to be playing the race of who's going to have the worst economy between Europe and the UK. And in that sense, I think the UK may be the one that suffers the most. But what we will have in here is still that rate divergence between the UK and the EU. So it may not mean that this is going to just start rocketing higher, but we're going to play the data. If we get one last hurrah down here, that could be one last chance to get in at levels down here if you think that this is going to be moving higher, if you think the Eurozone is going to outperform the UK. I've been saying for a while, I don't think we're done with this 85 level yet, but if we can't crack it over the Bank of England, then I would suggest maybe we are done. But it's all going to be down to data watching thereon. If that is the case, then I would at some point be expecting us to move up to this 87s. And if we get up there, there's every chance that we might have a little push on up through the 87s up towards 88s, and we start just to see it trending higher. This one needs a lot of patience. As you can see, we've just spent the last 3, 4, nearly 4 months in this tight range. When it doesn't want to do anything, it doesn't do anything. It will go sideways forever. So you've got to have a bit of patience with that. But if you want to be trading the differences between the countries, you know you've got a lower volatility pair to trade here. It doesn't cost a huge amount in the carry trade. So not like if you're trading dollar yen and you think the BOJ are going to do something, short dollar yen will cost you a ton of money. Doesn't cost you much money in this one, nothing that's restrictive anyway. So you can afford to sit in a trade for this one, depending on which way you want to go, of course. All the rest, not a lot going on really. Dollar CAD still holding this 135, 134.90 for now. Bounce is still looking pretty weak. Again, this is playing nicely with the techs, as it tends to do from time to time. 135.50 was at number on the way down, and now it's resistance. So you know your level. Then when we get into 135.80s, 85s, that's your next level. If we get a break here, then maybe we're going to have a bit of a fall out of bed if we get through that fib there. So that'll probably put pay to the rest of my longs. And as I've been saying for the last couple of weeks, it definitely feels like CAD is a bit more hawkish at the moment, or a bit more bullish at the moment. A lot of that obviously to do with oil, but no doubt the Bank of Canada, as mentioned, turning a bit more hawkish as well. And there's oil, and you know, we're into the 90s now. We do have a big level coming up here in the 92s, 93s. We can see we had a solid double top back in October last year. So that's the zone we're approaching at the moment. It's been a previous support and resistance area, as you can see, going back. So this is going to be a big test up here. Getting into that 93s, 94s, call it, area. Is that going to be enough to halt this run on a technical basis, or are we just going to blast through it and then everyone's going to get their $100 oil that a lot of people have been predicting? If you're trading the loonie, then you need to keep an eye on this, because of late we've been on and off the oil bust, but it definitely feels like it's on it at the moment. Although this keeps going up, but dollar CAD for now can't get through this zone. So there's a bit of a limit on this at the moment in how far this one is prepared to follow oil, but that influence is still there as well. Right, do throw me up any other questions, any other pairs you want looking at as well while I waffle on. As I say, I'm not looking at too much right now this morning. It's a bit quiet. We're in that treading water period. Dollar China just seems to be picking up despite the news as well. Maybe all that carry news has got the likes of Goldie's customers jumping in at the moment. Had another little test down here of this 725s 26 area that held, got a bit of a bounce. If we get back up towards 731, 732, I'm going to look to maybe add a little bit back into, excuse me, into the position that I took from up here. The shorts I'm in, just add a little bit in, job it around a bit in any further dips. Just continue to play on the short side on that one. Looking at some of the others, dollar MEX continuing its failure from the 740s. Now we're messing around with a big figure. If we do get under here, we're probably heading all the way back down near the lows again. So all that news about the banks ago halting 50% of their hedges and whatnot, it looks completely washed out now. This is still good for the carry as well at the moment. So maybe that's reasserting itself once again. Maybe we had a few of the short-termers who might have been, you know, getting short up around here, around the 18s. Maybe they got a bit scared out of this move that we saw. But if you look at it from a longer-term basis, there really isn't a reason why any of the early carry lot should be getting worried. You know, we just about got over the 38.2 fib, just this leg. You know, we're still light years away from the 30.2, 38.2 of this whole move. So, you know, if all the carry traders are up here, they're not going to be worried about this move here. All the carry traders maybe around here would have been getting a bit worried. All the latecomers might have been getting a bit worried, but they might have been shaken out, and then the trend reasserts itself. So below 17, we might be on for another move to these lows, and then we get to see, is that going to be enough, or are we going to head lower? Let's have a look. Ali, you're watching Aussie dollar for 25 days. Oh, exactly 25 days. Let's have a look at good old Aussie dollar. It's showing strong support if China recovers. Aussie can go higher, but what about the new RBA? Will they be dovish or hawkish? That's a good question. We know that Bullock's taken over from Lowe, so we really need to see how she leans in terms of, you know, her policy stance. It's one thing when she was obviously deputy governor or whatever, and we obviously heard from her plenty of times, but it can be a bit different when you're finally in the hot seat, having to face the press and, you know, explain the decisions away. The RBA are a bit of a loose cannon when it comes to monetary policy. You know, they were hiking, then they paused, then they hiked, then they paused and whatnot. So, yeah, Aussie can go higher if China improves. It's the general correlation. But what I would say is we've had various headlines coming through. We had the RRR cut coming through last week. But really, we're not breaking anywhere new still. We're not letting go of these lows. Things are still fairly tight. So we're looking for something to happen. You know, we get above 64, we hold above 64, that's a first step. But as you can see, it's just the same old price action we've got here. Maybe we move up to 65, 65.20s, maybe we go down to the lows. I don't see any reason for this to change yet. And I think what's really going to change this is if we get, you know, strengthening data out of Australia, maybe strengthening inflation data, or we do get China, you know, showing a bigger turnaround, bigger improvement. But that will only be a drag via correlation, not because anything's good in Australia or better in Australia, and potentially because nothing's worse in the US. So it's really going to take probably the US dollar doing something, or the Fed doing something that's going to kick this in. If the Fed indicate that perhaps they're on pause, and that pause is longer, and the possibility of a hike the rest of the year is maybe sliding off the table, then maybe you've got a bit of confidence to think about a better bottom, a stronger bottom forming down here. Maybe we get a push above 65, but that's your level, 65, 65.20 to 40. If you get above there and it starts holding the support, then that's your indication to try longs perhaps and look for a move up maybe to 66, 67s. But I'm not expecting rockets, Ali. So don't ask me about rockets. It may grind up, but I'm not going to expect it to go 65, 68, 70 in the space of a couple of weeks. Keep your expectations for some of these moves quite low, because even if we get into a rate cut cycle, it's only going to be getting rates to neutral levels, which may be 2.5%, 3%. So you're only looking at, depending on what it is, between 150, 200, 250 points of cuts. So 4, 5 cuts maybe of 25 pip increments. That's not a lot compared to going from 0 to 4, 5, 5.5%. So keep your expectations well grounded, but trade the levels. If we break down below this lows here, we've got that trend line coming in still. Let's go a bit wider. As you can see there, get below these sort of levels, then maybe we're looking at these low 62s again, down to the 61.90s. 61.70s, let's call it that. So down, this was a bit of a big zone down here. It was prior traffic, as you can see, going back. So that's going to be a big area, but only if we break below sort of 63s in that trend line will we be looking at that. In the meanwhile, it's stopped going down in terms of this phase, so that's all you can do with it at the moment. Right, let's have a look. Cable took out Friday's low. Yeah, I'm not disappointed. I had the trade all set up, but because of the events that were going on, I pulled a lot of my sell stops. I was trading long off this 124.50. Excuse me. I was trading off this 124.50. I did have sell stops at 124.35, but I pulled them over the big data points and ECB and whatnot. So I didn't get back in. This was a perfect example of going back to retest the level and holding. I didn't get back in there again because the events, I didn't fancy it, and it has moved down. So the break is looking pretty solid at the moment. As Gavin points out, we broke the Friday low this morning, so that continues to keep the bearishness in play. Watch the bounces. The bounces are looking a bit limited up to around 124. So if that remains, then the possibility is we're going to push down. How much we do, as mentioned before, we get to the BOE or the CPI data on Wednesday remains to be seen, but it's not looking too hot at the moment for the pound, as mentioned, as it isn't for euro dollar staying below 107. So similar picture, but the low looks a bit more solid than it does in cable. We bounced off that low. We're not getting back down there. Cable's making fresher lows. So cable's definitely looking a bit weaker, which again supports my longs in euro sterling, as mentioned a moment ago. So yeah, it's hard to take a side and say now with all these events going on this week, all these central banks. Really, it's just about planning. Pick your levels. Look at your levels where, if something happens, you're happy to get in. So if the BOE is hawkish, where would you potentially want to fade that? If that's the case. On the other side, if they're dovish, where is that going to run into trouble? They may be dovish now, but it doesn't mean they rule out rate hikes later. If they're dovish now, euro sterling, as example, is going to pop. Where's it going to run into trouble? We know where it's going to run into trouble, 86.5 up to 86.70. If you can't get through there, then you know what you need to do as far as trades go. Do I think today's Canada data can move the CAD? Yeah, we've got PPI out as well as those housing starts numbers. So yeah, potentially the PPI data. Was it even on there? Don't even on my calendar. Oh, there it was. Yeah, PPI data. So yeah, we've got the PPI data today. Obviously CPI tomorrow. So a lot of price data here to move the needle. If it's hot, then I think dollar CAD's heading lower. If it's softer, there's no real expectations on this PPI data. So we only got the priors to look at on that front. But yeah, if it is hotter, I definitely think we're going to see dollar CAD moving lower or CAD gaining. So keep an eye on that. And then obviously the CPI tomorrow will be the hot one. And it is a case that this smaller data may have a bigger effector ratio because the market isn't going to go out on a limb. So if you do get data, it gives the market something to do, something to trade. We've obviously had the BOC, so it can trade the CAD without getting too far out its pram in terms of what the central banks are doing. But look at what it does. If we see it react to data, but then just revert back, say dollar CAD moves down on a hot number, but then it quickly bounces back, you'll know that the dollar influence and the Fed influence is outweighing the Canadian data. But then you need to keep that in your back of your mind. You've seen the reaction, what happened to the CAD on strong data. When we get over the Fed, then that may take a bit more influence. So always, even though the price, you might not get the exact price move you think might happen, you know what it did in the meantime, you know what the data was, because that can factor when we do get to BOC time and whatever. So yeah, I think it could be a bit of a mover, Horatio. Have you looked at US 2? Yeah, we're not sure what's going on with this. There was a couple of spikes, or a lot of charts showing these spikes. I don't think they're real. We've had previous spikes before. So we've seen it in 10s, seen it in 5s, seen it in 2s. I'm not sure it's a real print or not, or if it's just maybe a bit of a fat finger. I mean, it came right into the close and early morning. So we're not too sure if it's a real print or just something a bit funky, as it can often be. Maybe just a low liquidity, a big order going through, just spiked it up. Yeah, it's certainly not reflected too much in the others, just the US yields. So yeah, we're not 100% sure what that is, Austin. If I hear any news of it, you'll hear about it here as well. Right, I'm going to call that a session for today. Hopefully got you set up for the day and week ahead. Obviously, we'll get into the central banks in more detail as the week progresses, each one, and get us set up for some trades and what to look at. Have a great day, everybody. Have a great week. Stay safe and join us in the rest of the week on the Flow Show. Thank you very much. See you later.